afternoon / Sunday morning. We will get right into the super chat. So guys, if you have a question, you want to make sure I see it, I'm going to answer it to the best of my ability. Do a super chat. And I've got Sebastian right here on the line. He's going to text those to me in real time. And we'll get right into it. Let's see. Do I have any house cleaning stuff? Oh, yes, I do. Guys, I am interviewing my favorite investor of all time this week. I'm completely just over the top excited. Let's see if anyone can guess who that is. Who do you think my favorite investor of all time is that I am interviewing this week? Let me see in the live stream. Well, maybe my live stream isn't working. Oh, here we go. Ben. Yeah, Paul Krugman. Oh, Brandon. That's funny. Paul Krugman. SpongeBob? Maybe. Warren Buffett? No. Ben got it right on the nailed it. Jim Rogers. It's Jim Rogers. I'm interviewing Jim Rogers this week. I'm just super excited. And I think I'm going to be able to ask him some questions that are very unique. So it's not going to be just a typical Jim Rogers type of interview. I think a lot of the people that interview Jim just, I just don't think they've got a good grasp of what's going on. I don't think they have a good grasp of the nuance as to what's going on. They just ask him these broad general questions. So I think I'm going to be able to extract some information from Jim that you may never have heard before. And I'm keeping my fingers crossed. So anyway, let's get right into the super chats, guys. We've got Joseph from, I think, is that the first super chat? Okay. Joseph from Kansas City. Thank you for the super chat. 33 years old, selling some real estate. I have $600K from a sale and thinking about putting all in the stock market. Yikes. Okay. Is total market index fund too passive? What do you, Joseph, I'm not sure if you want, have you ever watched my channel before, Joseph? Wow. Okay. Let's go into that. First of all, congratulations on the sale for 600. That's fantastic. Good for you. Do not. Well, I'm not going to tell you what to do. I'm not going to give it specific investment advice because I don't know your situation, blah, 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 blah. What I would do is if I had 600, there is zero chance I would put it all into the stock market, and even less than zero chance I would put it all into an index fund. There's a negative chance that I'd put it into an index fund. Let's go back to the way I like to set up my own portfolio. 3 compartments. 1 is insurance. 2 is investments. 3, speculation. I like to have 10% of my portfolio in investments, or excuse me, insurance. The only thing I see as insurance is physical gold. That's it. So right there, you got 60 grand, boom, physical gold. Then I look at 10% of my portfolio for speculations. I consider a speculation, I'm buying XYZ asset for the sole purpose that I think it's going up in price. So I think it's cheap right now. An investment, I like to have 80% of my portfolio, and that's something that pays me to own it. So a rental property would be a good example of that. A dividend paying stock would be an example of something that pays me to own it. So I would look at your portfolio and I'd do the 60,000 for, well, if it was my portfolio, I'd do 60 grand in gold, just boom, any price, doesn't matter. And then I'd go over to the speculative side and I'd say, okay, what do I think is cheap right now? Personally, I like things. Well, going back 4 weeks, I was lucky enough to buy at almost the bottom of the market. And I think it'll probably go lower, but as of the last, call it 3 months, I bought very close to the bottom. And it's not because I timed the market. And I get those questions all the time. George, if you think the market is going back down, why don't you just wait to buy at the lows? Because you're not timing the market. Get that out of your mind. It's not, you don't start with the question, is it going up or down in price? You're starting with the question, is it cheap? That's it. Or on the sell side, is it expensive? I think it was on Twitter last night. I went back and forth with someone briefly who asked me that question about the gold miners that I purchased. And again, I purchased them maybe 4 weeks ago. I got them. They're up 44% since I purchased them. And they said, well, George, if you think the market might go back down, why don't you just take the 44% gain, sell while you're ahead, and then wait for it to go back down and then buy again? Because that's not the game I play. That person, and they're thinking of it the way 99% of investors or speculators think about their portfolio, and they're starting with the wrong question. And that question again is the asset going up or down in price? We want to get that question out of our minds, just gone. So I bought the gold miners 4 weeks ago, let's call it. And so why am I not selling? Because it's not expensive yet. That's it. I'm not going to sell them until they're expensive. If they go down in price another 50%, okay, cool. If they go up in price another 50%, awesome, great. I'm not selling. It could take me 5 years. It could take me 10 years. And I'm not going to sell until the charts, the data, the facts show me that historically speaking, adjusted for inflation, those gold mining shares are expensive, right? So I want to make sure, or I want to encourage you to think of things that way. If you want my advice, or if you want to know how I would do things, or how I would suggest my family members do things. So as far as I can't tell you exactly what I would go into right now as far as investments and speculations. You can watch some of my past videos. You can watch my videos with Chris McIntosh, my interviews, to see kind of where I'm at. But that's how I try to encourage you to think about your portfolio right now that you've got the 600 in cash. Angela, thank you for the super chat. I own a surgery center. Okay, 1/3 unoccupied, struggling to find a tenant. 2/3 elective surgeries who are not paying rent. Okay, thinking of trying to get rid of it even at a loss. What do I think? That's a tough question, Angela, because I don't know the area. I don't know if it's in a great area, if what the future, I don't know if you have debt on the asset. I can tell you that just me personally, I like residential a lot better than commercial. When I first got into real estate in 2012, as most of you know, I bought a lot of residential properties, but I also bought a commercial property. And I got it in a short sale, and it was okay. I mean, I made a little bit of money. I ended up selling it a few years ago, but I didn't like it because in order to get a tenant, I didn't really have any control over it. A new tenant wants to come in and kind of white box it. And so with the residential properties, on the other hand, I had a lot of control over how quickly I was renting them out. I could do a quick remodel. I could paint. I could maybe put in some new cabinet doors, or maybe some new a new countertop or redo a bathroom. Maybe I could drop my price by $50 a month, and then you just rent them like that. Where the commercial, as you can tell, a commercial location, sometimes you can drop the price and it just doesn't matter. If you don't have any demand for that particular location, your price could almost be zero and you won't get any action on it. So, and then when you go on the sell side, it's a lot less liquid because you've got fewer buyers. If you got a residential property, you've got investors that could be potential buyers, and you have owner occupants that could be potential buyers. So it's far more liquid. That said, I would start by asking myself, currently, is it cheap? Is my cash flow, assuming you're at 100% occupancy, and assuming that that was realistic after the cerveza sickness, at 100% occupancy, is it a good deal? I mean, is your RV ratio over 1? What's your net ROI? I would ask myself these things, and if the answer was yes, the ROI is really, really good, and if after the cerveza sickness I felt as though I would get back up to 100% occupancy, then I'd keep it, assuming you didn't have a lot of debt and you're not getting overwhelmed by a mortgage payment when you don't have any rents coming in. But if it's expensive and if it wasn't that great of a deal to begin with, yeah, maybe I'd just go ahead and sell and take my losses and then just move on to something that was maybe a better fit. And I know for me, that's what I did when I sold the commercial building. Is I didn't make a ton of money on it, just a little bit, but I made some decent cash flow. But I just took that money and then parlayed it into residential because I learned my lesson. I learned that I wasn't very good at commercial at all, and therefore it would be a better use of my time and capital, even if I had kind of my tail between my legs, so to speak, because I kind of got my butt handed to me. Even that, it's better that you take that resource, that capital, and allocate it in a way that's going to be better, that's going to be more productive long term. A great example of that would be the property I own in Ecuador. And many of you have heard me say that that's the one real estate investment where I've actually lost money. I've been fortunate to make money on literally every real estate investment I've ever made, except that one. And it's because I broke my own rules. But I learned a great lesson, and I actually still own property there. But the one property that I sold, geez, I lost probably, 50 grand I lost on it. And that was a good percentage of what I paid. So, but my whole view was, listen, I bought this land. It doesn't produce income. I shouldn't have bought it in the first place. I broke my rule of investing, and I also didn't buy it when it was cheap. I bought it when it was expensive, thinking that it was going to get more expensive. And but it's better for me just to take a $50,000 hit, learn my lesson, and take that money and invest it elsewhere. And since I've sold it, I've probably made back at least a good portion of the $50,000 I lost by putting it into something that that is more productive. Ellie, thank you for the super chat. How did U.S. denominated debt grow so large? I'm pretty sure U.S. is a debtor nation and not a creditor nation. That is correct, but you're kind of conflating two things, Ellie. So let's compartmentalize that for a moment. First of all, what you're talking about as far as the U.S. denominated debt, I'm assuming you're talking about outside the United States. So that goes to countries and foreign corporations who just loaded up on debt back in 2000, call it 11, 2012. Why did they do that? Because back then the dollar was cheap. The dollar was very low. It was down near 70, 75 on the DXY. And the Federal Reserve, of course, goes back to the Fed. They dropped interest rates down to 0%. So let's just pretend you're a country like Colombia. And to borrow in your own currency, you would have to pay 6-7%. on those bonds. But to borrow in dollars, you could get that same loan for a lot lower interest rate, maybe 1%. So there is some credit risk there with a different government. But if you're borrowing in that same currency, then hey, you've got investors don't have any exchange risk, or a lot less. So they're willing to give you that loan for, like I said, maybe 2% instead of 6%. Well, when you're borrowing billions and billions of dollars, that's a no-brainer. And also, these governments and the corporations have recency bias, just like all of us. Totally, just the exact same recency bias I talk about with average investors. These countries, these corporations have the exact same thing. So when they see the dollar going down, down, down from 90 to 80 to 75 to 70, they think that it's just going to keep going down forever. So why would I not just load up on dollar denominated debt when I can get it at 400 basis points cheaper than debt in my own currency, and the dollar is going down forever, right? So if the dollar goes down forever, I'm going to be able to pay that loan back with cheaper dollars. No brainer. Let's back up the Brinks truck. So but then of course that worked against them when that recency bias didn't turn out to be correct. Shocker, right? The dollar went back up, and now it's at 100 on the DXY, and you know the story. Now all these countries are completely screwed because they don't have the money, they don't have the dollars to pay back the debt, they don't have the order to even roll it over, and they got big problems right now. So that's what we're seeing play out, and that's what we see in the dollar milkshake theory with Brent Johnson, and Jeff Snyder has outlined that as well. So that's the first part of your question. The second part of your question, I'm pretty sure the U.S. is a debtor nation. Not only are they a debtor nation, they are the largest debtor nation of all time. They are the largest debtor nation ever in the history of the planet Earth. So that just means when an economists use terms a debtor nation or creditor nation, they're just talking about the individuals and the entities within the country and how much foreign assets they own. Emmanuel, thank you for this super chat. Hi, George. I am in Germany. 55% assets in physical gold. Deliberate choice, okay? And 45% in sovereign corporate bonds in the Eurozone. Wow. All right. Should I get out of the bonds now? Should I get out of the bonds now for cash, or wait and see? I mean, so let's go back to the way I look at investing, Emmanuel. I buy things when they're cheap and I sell things when they're expensive. So if we look at EU zone bonds, and I just asked you the simple question, Emmanuel, are they cheap right now or are they expensive? So I'm assuming you've got bonds that are in the 0% zone, maybe, who knows, maybe even negative. I think anyone would say, historically speaking, those bonds are expensive. They are super expensive. So if something is super expensive, I sell it right there. It's as easy as that. Don't want to overcomplicate it. And then as far as having 55% in physical gold, you know how I feel about that. I'm not going to beat a dead horse. If you feel as though that's right for you, great. I would actually encourage you to watch the options series I did with Patrick Ceresna from Macro Voices, because he talks about kind of using options to have a little bit of a hedge there if you've got a part of your portfolio that's overweight precious metals. Ike, thank you for the super chat. Plead the fifth if you want to on this one. Oh boy, here we go. Is revolution an organic reaction to tyranny? Is it inevitable, especially in the US, if dystopian socialism takes over? If you look at history, it tends to work in cycles, like, and usually, unfortunately, that's what ends up happening. Is it's not just that revolution from within is a reaction to tyranny, and a lot of times this takes a time. It doesn't just happen overnight. This takes decades and decades and decades. Or sometimes it can happen overnight. It really depends. But also, you've got to look at a country in decline and what is the typical release valve. And unfortunately, a lot of those release valves that you see with a country in decline, I see that right now in the United States. And I hope that we pull out of it and we start going the opposite direction. But you see it all the time. When a country's in decline, the very first thing they start doing is blaming foreigners. I mean, it's just, they look different, they smell different, they eat different food, they eat bats and all this stuff, and they pray to, they have a different religion, and it's all crazy, and they don't watch baseball, and people really get nutty with these things. But that's the first it's the first thing that people do, and it's the first thing that a country does, is they just blame foreigners. That's a very slippery slope. And regardless of how much blame foreigners have, once a country starts to look at the root cause of their problem being external, that's not a good thing. Not a good thing. And so, again, hopefully we can pull out of this. But my point is, yes, you typically see revolution from within, but a lot of times you see conflict between different countries as a result of not just tyranny, but the decline that you typically have in a nation that is a result of tyranny, or a result of more central planning, more government involvement, which produces a less efficient allocation of scarce resources with alternative uses. Cody, thank you for the super chat. Hashtag Gammon 2020. Yeah, not going to happen, Cody. I appreciate it, but I would be the worst politician of all time. And I'm quite proud of that, because I consider myself someone who tries to tell the truth. So that in and of itself would disqualify me from politics. But thank you for the kind words. Emmanuel, thank you for the super chat. I have been studying your channel and macro voices, and I am so thankful. My mother is retired. I have her partially to a self-directed IRA with precious metals focus. Most funds remain in different money market accounts. Where else do you think safe in the environment? I don't think the money market account is safe, Emmanuel. Well, it depends on how you define safe. What I'm saying is that I don't think the money market fund is as safe as you think it is. I'm not saying it's going to blow up tomorrow, or I'm not saying it's more risky than a mortgage-backed security or mortgage-backed sausage or a credit default swap or something like that. But I just think people see money market funds as just zero risk, and that's not true. As an example, money market funds are big players in the repo market. So if they're a big player in the repo market, what that means is your Is it your mom? Yes, your mom. They could be taking your your mother's money and quite literally lending it to Deutsche Bank or HSBC via the repo market. My guess is you probably wouldn't be that comfortable with a decision like that if you watch my channel or if you watch Eric. Excuse me, guys. Or if you watch Eric and Patrick with macro voices. So just, it's a great lesson though, in that if you give your money to a bank, even in a CD, that gives you a higher rate of interest than you would get on just a normal savings account, you got to scratch your head and say, okay, why? Why is that? Why are they able to give me an additional 100 basis points? Well, it has to be because they're taking more risk. Then the next step is to discover and do the homework yourself how they're taking more risk. And if I'm okay with the additional risk they're actually taking. Usually with those money market funds, they're able to give you this much more of a return, but unfortunately they're taking this much more risk. and people think that they're getting this much more of a return for this much more risk, but it doesn't work that way. In fact, I was on the phone the other day with Hartman, Jason Hartman, the real estate expert that most of you guys know from my videos, and he actually had like 200 grand or something, maybe even 250 in some sort of money market account that or money market mutual fund, something like that, that wasn't FDIC, and back in 2008, and he just got a call from his bank, said, "Yep, sorry, that's gone, poof," and just no recourse. And he thought that was a super safe investment. So anyway, make sure you do the homework on that. I'm trying to read the rest of your question to make sure I've answered it thoroughly. Yeah, I think I have. And I'm not exactly sure what you can and cannot invest in with the self-directed IRA. I would maybe just go into some T-bills instead of the money market fund, and just short-term T-bills. I'm not talking about holding on to U.S. debt for 10 years. A lot of people, when I say buy T-bills, they say, "George, what are you talking about? How can you be so bearish on the government and all this debt? And you're telling me to buy government debt." Yeah, I'm just telling you to buy the 3-month. That's it. And just keep rolling that over, and just for your dry powder. And then if prices go down and we get some cheap assets in something like rental properties, then I would kind of transition into something like that, a kind of hard asset that pays your mom to own it, right? Or maybe some dividend paying stocks if they get really cheap again. I'd think about, if it were my mom's portfolio, that's probably what I would be doing with it. Kalahari Desert, thank you for the super chat. How can you make money on real estate? No flipping when interest plus principal payments from the loan are always greater than the rent you receive. Where are you investing, my friend? What? I'm not investing where you are, Kalahari. I would never buy a rental property if I wasn't cash flow positive. Never. Let me make sure I'm reading your question right. How can you make money on real estate when the interest plus principal payments from the loan are always greater than the rent you receive? Yeah, you're just looking in the wrong places, Kalahari. Where I invest, I'm always cash flow positive. It doesn't matter. I could take out 100% LTV loan and I'm going to be cash flow positive, let alone call it a 60, 70% LTV. So I think it's like that old song. You're just looking for love in all the wrong places, buddy. You got to do some more homework. Looks like you're in the UK. Maybe it's because prices are so high there. You might want to consider investing in the United States, which you can do easily. And maybe now is not the perfect time, but if things get a little cheaper, maybe it would be a good time to pull the trigger, maybe in a year or something like that in the US. And if you do that, or if you're considering that, make sure that you go to Hartman's website, jasonhartman.com. He's a real good buddy. I trust him like a family member. And he really understands the real estate game better than anybody. And he has a network where you can buy in linear markets, good cash flow, A neighborhoods, just really quality assets where you're going to be wildly cash flow positive, even if you take out a lot of debt against the asset. Dapper Dave, thank you for the super chat. If the Federal Reserve is a private entity, why can't they forgive some or all of the U.S. debt? Also, what did they do with the bad mortgage-backed securities and CDOs from 2008? To answer your question, why can't they forgive all the debt? They can. They can. And I don't think they will, because if you go, well, let me be clear. I don't think they're going to explicitly say, okay, we forgive the debt. I think they'll implicitly do that, in the sense that, and this goes to the next part of your question, most of the mortgage-backed securities and or mortgage-backed sausages, I like to call them, they're still on their balance sheet. Remember that when the Fed tried to do QT and they did quantitative tightening, how long did that last? Just a couple of months before the Fed said, whoa, can't do that anymore. That quantitative tightening, that is the no bueno zone right there. So they learned very quickly that they cannot unwind their balance sheet without some serious damage being done to the marketplace. So my answer is all those bad mortgage-backed securities are still on their balance sheet. They haven't unloaded them. And that goes back to the first part of your question, where I think they'll just, if they want to implicitly allow people to default on the debt or forgive the debt, they'll just get as much debt as they can onto their balance sheet. And if people just don't make the payments, they just don't make the payments. And we have no way of knowing, because we can't audit the Fed. Go Ron Paul. And if we could audit the Fed, then that would be different. But who knows? I mean, if they've got, let's call it $2 trillion of mortgage-backed securities on their balance sheet, who knows if any of those people are paying? I don't know. You can't tell. So why wouldn't the Fed, just in a hypothetical in the future, why wouldn't they buy every single mortgage-backed security they could? And if homeowners are defaulting on the payments, they just don't tell anybody. And then the housing market never goes down. See, so I think that's kind of what the Fed's game plan is to get it as many assets, debt on their, or as many, debt-based assets on their balance sheet, and then just forgive the debt, like you're saying, by just kind of not telling anyone that they're forgiving the debt by not making people pay. I'm going to butcher this one, but I'm going to say thank you, Valahoreu. I know I'm butchering that. I apologize. But thank you for the super chat. Are you familiar with Tether? It's the 4th largest market cap in crypto. They claim that they have every Tether back 1-to-1, no audit ever provided. Most of the volume in crypto done with Tether. I have not heard. I think I've heard of them, but I haven't done any research. So I really can't give you any insight other than to suggest, if you're looking into the crypto space, there can be some great asymmetry there. But if it were me, I would only do that with the speculative side of my portfolio. And that way you can take advantage of the upside. But if something like Tether or maybe one of the other cryptos, if it does go to zero, then you're not that effective. It's not changing your lifestyle one way or the other. Where if you got 50% in there, another thing I'd like to mention, I can't remember who I did the interview with. It was one of my recent interviews. I think it was a Luke Groman, which was a fantastic interview, by the way. If you guys haven't seen that, you got to check that out. But we talked about having a large portion of your portfolio in any one given asset, and how even if from a math standpoint, it might make sense, from an emotional human standpoint, that's where you really run into problems. Because no matter how rational we like to think we are, and I'll put myself in that in that category, we're really not. And if you have 100% of your portfolio in something, just think of how often you're checking the, oh my gosh, what's the spot price? What's it doing? What's it doing today? You've got that app up on your phone and you're checking it nonstop. That's not a good thing, because then when do you sell? Right? Let's say it doubles, and then you're going to sell, and then it goes up triples, quadruples. It just gets you too emotionally engaged. Where a good example was the stock I bought in Cyprus back in 2012 or 2013 when they had their bail-in. After they had their bail-in, the stock market went down by 99%. So I bought some stock in one of the hotel chains there. Got to buy things when they're cheap, right? And they were super, super cheap. But I just did it with, I don't even remember how much. It was right around 10 grand, something like that. So it was just a portion of my portfolio that was very insignificant. So I never had to worry. In fact, I would get emails from my broker, my statement, and I wouldn't even open it. I was just like, whatever it's doing. And then sure enough, I was never really tempted to sell, or didn't even really care, honestly. I knew that it wasn't going to zero, because I would check the entire market periodically, once every 6 months, say, I wonder how it's doing. And I saw it going up a little bit. So I knew, I was pretty confident that the shares I owned didn't go to zero. But even if they did, I wasn't too worried about it. So, but then just a year ago, I hadn't seen my statement or my bank or my account in like 3 years. And I checked it, and it had like quintupled in price, and the dividend went up to like this crazy amount. And I, of course, I didn't sell because it's still cheap. But if I would have had 100% of my portfolio in that asset, maybe I would have sold earlier. I probably would, because I would have been much more emotionally engaged. So I think that's my point. Atlas, thank you for the super chat. Hey, George, are the RV ratios in Medellin better than your rentals in Kansas City? Are you still flipping in Medellin, or are you renting them out? Right now, Atlas, everything is on hold. I can't, we're on a government lockdown in Medellin, so I can't get workers into the properties to finish them. For any of you who followed the real estate vlog that I had up on the channel when we first started, you'll probably recognize the art apartment. We were like 2 weeks from being done with the art apartment, and then we had the whole cerveza sickness deal. So it's just sitting there. I can't get workers in. When we open things back up, then yeah, we're going to go ahead and sell the art apartment. And then I've got a couple other projects that we're going to sell. As far as your question on RV ratios, let me answer that two different ways, because the rental properties I have in Kansas City, I purchased in 2012. So it is just at the absolute bottom of the market. So my RV ratios relative to my cost basis are ridiculous. Like 14, or like maybe even close to 2%. Well, probably 1.5. Actually, maybe they're close to 2. Yeah, my RV ratios are just completely obnoxious because my cost basis was so low. Now, if you're asking me, George, if I were to buy today in Kansas City, where I might not be able to get a 1% RV ratio, are the RV ratios better in Medellin? Yeah, they are. I can get a 1% RV ratio easy here, and that's without using any debt at all. So, yeah, well, I was talking about return. Yes, the RV ratios are better here, but you got to know what you're doing. That's the key with Medellin is if you don't know what you're doing, you can get your butt handed to you because the market is incredibly inefficient, very little information. You just got to know, like the comps and the price per square meter or price per square foot, and all the costs and all the things that go into it. You've just got to know that. You can't read that on a blog. It's not. There's no MLS. You're just you got to know it. And if you don't know it, you're most likely going to lose money until you learn those lessons the hard way. Fortunately, I knew the market well, and I had a good team initially, so I've made quite a bit of money right from the get-go here in Medellin. But it's not like the States where there's all this information and there's not a lot of downside. Where here there is if you don't know what you're doing. Now, if you know what you're doing, the opposite is true. There's a lot more upside than the United States because of the lack of efficiency. Bumper, thank you for the super chat. I'm 38 with 300,000 in cash and cars paid off. All right, good for you. Awesome. 95,000 in retirement, $60,000 a year job that I hate. All right. Well, other than your job, you're doing great, Bumper. And I want to do something more entrepreneurial. Advice. Bumper, I've done, as you probably know, I was an entrepreneur for, longer. Well, how long was that? 12, 15 years I was an entrepreneur. In fact, I never really had once I got out of college, I never really had a quote unquote real job. I had a couple. But I just kind of went right into that realm where my paycheck was completely reliant upon my ability to start and run a profitable business. So I've done things in the brick and mortar world, and I've had a variety of different businesses, but I've also, now that I've started this YouTube channel, I've done them in the online world. And I can tell you from experience, the online stuff it's not even comparable how superior it is. Let's just use one of the businesses I started in the mid 2000s. This was 2006-ish, something like that, 2007. At that time, I had $100,000 that I was putting into the business to start. I borrowed $400,000, so I had $500,000 in total to start this business. And that business ended up, through a bunch of iterations and whatnot, it ended up, let's say, just produce, well, I shouldn't go into exact numbers, but it became a successful business that was a 7, let's see, what would that be? An 8-figure business. Let's just call it that. And so But that 8-figure business, it took me $500,000 of startup costs and a lot of stress and massive payroll. And even once we got up and going, that I took that 500 down to where I almost had nothing in the bank, and we were struggling to meet payroll there for the first 6 months or so. And so compare that to a lot of these guys that you have, and gals online, that are doing like what is that, fulfillment by Amazon? I can't remember the acronym, but is it FBA? Is that what it is? I don't know. Anyway, you guys know what I'm talking about. These guys and gals that are on Amazon selling these products where the out-of-pocket cost, and they've got an 8-figure business, or they've got a 7-figure business that's bringing in just as much profit as my 8-figure business that I started back in 2006-07. And so they're doing it at just a fraction of the risk. And you can scale it faster. You can, well, it's infinitely scalable if you're selling some sort of digital product. And with the brick and mortar stuff, it's very hard to scale. And what ends up happening with a brick and mortar business is, in order to produce in order to create an 8-figure business, you've got to have 100 employees. So your business goes from what you think it is to babysitting. That's your business now. It's babysitting. It's babysitting your 100 employees. So that's what you signed up for. Congratulations. So my point is, these guys and gals with these 8-figure or 7-figure online businesses that are selling digital products or doing fulfillment by Amazon, they do this with like 10 employees. And their employees are like in the Philippines and all over the world, and they do it. It's just incredible, the opportunities now compared to what they were back in the good old days, right? So I would encourage you to use my YouTube channel as an example of what you can do. It's a very esoteric subject. No one in their right mind would think, you know what, I'm going to make a killing online. I'm going to start a YouTube channel on macroeconomics. Yeah, everyone's going to love that. I'll talk about the repo market and quantitative easing and euro dollars and the dollar denominated debt. And that's just going to blow up and be hugely popular. Of course, no one would have said that. And my point is that what another neat thing about the online space is, it doesn't matter. You don't have to have this. You don't have to have a deep knowledge base in this huge topic that everyone loves. Call it fitness or weight loss or something. It does. You are an expert in something. Whatever you're doing for 60 grand a year, you're an expert in that. So just think about what you can do to provide value to people in the online space, and don't quit your 60 grand a year gig. Just try to start something online, and go to Miles Beckler. I mean, I had him on, and it was a little off topic for the channel, but I think it's one of the most important interviews I've done for someone in your position. And check out his stuff. It's all free. It's all free on his YouTube channel. And just kind of, hopefully that'll start planting the seeds as to what you might be able to do. But don't quit your gig. Just start a side hustle, if you will, at nights and on the weekends, and just gradually grow it up, or just gradually grow the business to where maybe after a year, it's only making $1,000 a month. Okay, fine. But you just keep doing it. And you get some compounding growth. So after 2 years of sacrificing your nights and weekends, now all of a sudden it's making $4 grand a month. Okay, now it's getting pretty darn close to the income that you're making on your gig. Do it another year. Now maybe you're making 6 or 7 grand. Okay, now you're making more on your side hustle than you are on your actual job, then you can go ahead, quit your job, go into the side hustle, now treat it as a real business, start investing money back into the business, grow it, boom, there you go. And you've done that, and you've created that 7-figure business, let's call it, with almost no risk at all. You're not having to quit your job. You could probably start that business with $1,000, probably less. And you get the same benefit as I had by taking $500,000 and just taking an epic amount of risk that now, as in my older years, if you want to call it that, keep in mind that was when I did that when I was probably, I can't remember. I was in my low 30s, like 31, 32 years old. So back there, I mean, you're a gunslinger, right? You can't fail. You're just shooting first and asking questions later, and you just think you're invincible. I look back at how much risk I took. I look back now on how much risk I took back then, and I'm just like, I almost get like a little afraid, like, oh my gosh, like I kind of relive it in my head, and I like kind of have a nightmare. I gotta like snap myself out of it. Like, oh, George, you're in 2020 right now. It's not till, thank goodness I'm not taking that much risk anymore. I almost can't believe that I had the huevos, let's call it, to pull the trigger. But like I said, I was a cowboy. I was a gunslinger. So my point is if you do it online, you can do it with a lot less risk, have just as good, if not better, a result. So that's what I would suggest to someone in your situation. Funding Jim, thanks a lot for the super chat, buddy. It's good to see you on the live stream. And I you know who else I saw on the live stream? I just saw it out of the corner of my eye, and I think I saw my buddy Suicide Van on the live chat. So if you were there, it's good to see you, buddy. I hope you're doing well. I know you're doing some remodels on your house that you bought in Denver. And so hopefully, I think the last time we talked, you're doing something with drywall. You're doing some, I don't know if you're finishing your basement or doing an add-on, something like that. But anyway, hopefully that went well. My buddy Suicide Van was probably like my 100th subscriber. It maybe even less, maybe like the 50th subscriber that I had. And it was kind of a funny story. I remember it well. We would always go back and forth on my comments because he was like the only person commenting on my videos 8 months ago, let's call it. And then the YouTube algorithm picked up the channel, and it just boom, it just exploded. And my channel went from getting like literally 50 views a day to getting 40,000 views a day. And it just happened in the span of like a week or two. And my buddy, I go in the comments, I remember he's like, what the hell just happened? He goes, a week ago, it was just me and George going back and forth. And now all of a sudden it's half the country. So I always remembered that comment and got a good chuckle out of that one. So anyway, appreciate you being on the live chat as well. And I know Funding Jim is here all the time. Okay, so Funding Jim, your question, how to decide length of lease we'll offer to the tenant? Well, if they're a good tenant, I'm going to try to lock them in as long as I can. When I first got into the rental game in 2012, I remember I had a tenant that came in that said, and she was fantastic. I mean, great credit score, great job. I mean, awesome. And she was like, well, would you mind if I did more than a 1-year lease? I'm like, yeah, just twist my arm, right? And she did a 3-year lease. And man, she was an awesome tenant. So yeah, if you can get a 3-year lease, if it's a good tenant and you're really confident, I'd definitely pull the trigger. In fact, I would go so far as to give them a little bit of a discount if they wanted to do a longer term lease. Free Thinker, thank you for the super chat. Love the show. Let's say gold goes up 10% in the next month. Okay. Do you sell to maintain the 10% allocation? Ah, good question. Do you sell to maintain the 10% allocation even though there's still a lot of upside? That is a great question. I've what I do is I just hold it. I don't even think about rebalancing your portfolio. I just, and it's probably the wrong way to think about it, but I just kind of see it as my portfolio is always as it exists. I think the reason I do that is because you're talking about a paper gain, and I'm just looking at my cost basis. And I want to be clear. I'm not saying that I'm doing it the right way. I might be doing it the wrong way. Because let's say gold goes up to $50,000 an ounce, or let's say $10,000 an ounce, and I still historically, in relative to inflation, it's not expensive. But then it's 50% of your portfolio. Do you sell? I don't know. I'm going to have to think that through. That's a great question. What I can tell you is what I've done in the past, even with real estate, going back to 2012 when I retired, is I don't look at the paper value of it or the market quote. I just look at my cost basis. And so, again, I'm not saying that's right or wrong, but that's what I've done in the past. Jacob, thank you for the super chat. Greetings from Norway, George. All right. Thanks, Jacob. Thank you for tuning in. Do you believe that gold will have a pullback after this current rally? I am currently invested in gold royalties. Well, congratulations if you're invested in like Franco-Nevada. I think they've done extremely well. And the more I talk about it with my buddy Jason Burrick, he really gets into the weeds with the actual companies more than I do. He really loves that. He loves the royalty companies, the gold royalty companies. As far as will it have a pullback? I'm not sure it will, because the reason I think it had a pullback initially, especially when you look at Jeff Snyder's charts going back to 2008, is because it was a lack of liquidity, as a collateral issue, and the entities just had to fire sell whatever they could to come up with the liquidity. So has the liquidity problem been, do we have a band-aid from that, or do we have a band-aid for that from the Fed? I don't want to say they've solved the problem, because as we know, they definitely have not solved the problem, but have they given it enough of a band-aid to where if we do have another downturn in the market, there isn't as much of a liquidity issue or a collateral issue, a pristine collateral issue, like I want to use Snyder's terminology there. So I would say maybe, but my conviction isn't really high, because I think that we could have a liquidity band-aid. But also, Jacob, I want to make sure that you're not falling victim to the temptation of asking yourself, are prices going up or down? I kind of get that vibe a little bit from your question. So what I'd leave you with is if you are trying to figure out if the price of gold is going up or down, I wouldn't do that. I just ask if it's cheap or if it's expensive. And if it's just your insurance, the insurance part of your portfolio, then I wouldn't even ask that question. I'd just buy 10%. I don't try to time that. If I get an extra 100 grand, I just take 10 and buy gold. And to be clear, I'm not buying physical right now because I can't, because we're in lockdown. So I'm just buying Rick Rule's ETF, the PHYS. That's what I'm buying in the interim. And I plan, when things open back up, I plan on most likely selling that and just rolling that over into physical. Larkval, thank you for the super chat. George, you should debate YouTuber Meet Kevin. He is a fast-talking MMT party animal. You need to take him to school. I've watched several of Kevin's videos, and I know my mom's a big fan of Meet Kevin because she's a real estate agent in Vegas. And the first thing I want to say about Kevin is he is a creative genius, and I mean that quite literally. If you had a YouTube channel and if you produced YouTube videos, and I've got the benefit of prior to having a YouTube channel, as most of you know, I had a TV show here in Medellin. It was a house flipping TV show, just like Flip or Flop or any that you'd see in the States, where I was the executive producer, I was the producer, and I was actually in the TV show along with my architect, Joaquin, and my designer, Angie. It was the three of us. So I look at his videos from a little different perspective. And I can tell you what he's doing creatively is phenomenal. I mean, he's really talented when it comes to his creative genius. And I'm not using that term lightly. As far as his views on macro, and I wouldn't call him a party animal. I think he's got a couple little kids, doesn't he? I don't think he's a party animal. But as far as his views on economics, if I'm not mistaken, I think Kevin has a degree in economics. And that said, since he has a degree in economics, he probably has been trained under the Keynesian school. And so I think a lot of his views are very Keynesian. I wouldn't agree with them. But I don't want to detract from how talented he is as a YouTube creator. I think that's the best way that I can say it. As far as me debating him on macro, I'd debate anybody. I'd do it just for fun. I'd love to debate him. I'd love to debate anybody, though. I just enjoy talking about this stuff regardless. And I think if I got into a debate, it might be a little more worthwhile than a typical debate, because from my standpoint, I don't just try to prove somebody wrong just to burn them and ha 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 ha. I try to really take it from the angle of keeping an open mind and really trying to understand what that individual is saying and how they're thinking about this. And I try to do that to improve my own framework. A good example of that would be Steve Keen, right? I mean, Steve Keen is definitely not a typical Keynesian, but he's definitely not an Austrian, that's for sure. And Steve Keen is fantastic. I cannot wait to interview him again. And I don't see eye to eye with him on everything. As far as the analysis of the fundamentals of economics, I think I agree with him on pretty much everything. As far as the prescription, I might have a little bit of a different opinion, but that's fine. That's okay. That's okay. I want to make sure that people and everyone on my channel isn't falling victim to an echo chamber type of mentality where you only listen to people that agree with you. If someone is coming from this, coming at economics from a standpoint of intellectual curiosity and not just trying to prove that I'm right and I'm the cool guy that got everything, all his predictions correct, and none of that nonsense. If you're coming from a standpoint of intellectual curiosity and you've done research and you're a real smart guy or gal, I think it's fantastic that you have different viewpoints, and I can't wait to learn and understand those viewpoints so I can hopefully figure out this 3, 4 to 5 dimensional puzzle that is macroeconomics, and hopefully I can understand those positions to make my own positions even stronger. Because maybe if I have a conversation with Steve or Jeff does this. I agree with Jeff in pretty much everything. And I think Jeff would really lean more Austrian if you had to kind of pigeonhole him into a certain school of thought. But every time I talk to Jeff, he like blows me away with another thing to think about that I hadn't considered before, or maybe that I had just kind of gotten wrong, because there's so much nuance in macroeconomics and in the plumbing of the dollar funding markets, as an example, that it's just very complicated, right? And so my point is, if someone's coming at this from a standpoint of being a really smart person, very well researched, I'm willing to talk to anybody, and I think that you could use that as a benefit. And you always want to get outside of that echo chamber. But to answer your question specifically, I'd love to debate Kevin. I'd love to debate anyone. I think it would be a lot of fun. But I would do it from a standpoint of respect. And I want to give him a little bit of a pass, just because if my memory serves me right, he's got his degree in economics, which means he's been brainwashed in this Keynesian demand side approach, and he's a young guy. I mean, come on, you can't blame him for that. And lastly, I want to reiterate that I have a tremendous amount of respect for him, and also Graham Stephan, and Graham. I've got a tremendous amount of respect for him as well. As far as he's just incredibly talented at producing content. And I don't agree with them on everything, but it doesn't mean that I don't have a lot of respect for them for just being creative geniuses. Neil, thank you for the super chat. What is your opinion from the recent Macro Voices podcast with Josh Crum, where Eric Townsend claimed GLD is safer than physical? Well, I'd have to listen to that specifically, and I'd have to figure out why Eric is saying that. He might say that it's safer because of increased liquidity. He might be saying that from a trading standpoint. I need to understand the nuance. Going back to the earlier question, I'd have to understand the nuance in what Eric is talking about. Obviously, I've got a tremendous amount of respect for Eric, good buddy of mine, and I would, if he says something, I definitely want to listen. So I'd have to really just know the details as to why he's claiming that, and then just do the research myself. Matt, thank you for the super chat. Who will win in a fight between Ben Bernanke and Paul Krugman? No weapons, but Bernanke just bumped. But Bernanke just bumped Coke, and Paul Krugman is allowed to tag in Janet Yellen. Oh, well, they'd never fight because they're two peas in a pod. They love each other. They just hold hands, Matt, and just sing Kumbaya. It wouldn't be a fight at all. Now, who would win in a fight between Ben? Okay, here's a better question. Who would win in a fight between Ben Bernanke and 1980 Paul Volcker? Remember the picture, the black and white pictures of him like in front of Congress when he's got that cigar and smoke and the glasses, and who would win in a fight there? Oh my gosh. It wouldn't even get to a fight because Paul Volcker would just stare him down and Bernanke would just whimper away into the corner. Oh, and then Krugman, give me a break. Krugman isn't fighting anybody. Krugman's just battling himself. Yeah, Krugman fights himself, because if you look at what he says now compared to what he said like 10 years ago, he totally contradicts himself nonstop. So I think that's the clash of the Titans is Paul Krugman versus Paul Krugman. But yeah, I love your question, Matt. Thank you very much. Maybe this is maybe I'll have to incorporate this into a whiteboard video and make stick figures, just doing like a central bank Keynesian battle royale, and with Vince McMahon, Stone Cold, and The Rock in there trying to spice it up a bit. All right. XRP, Bull on the Moon. What are your thoughts about shorting REITs? I don't know. I don't really like shorting that much in this type of environment, because the Fed is just, I think, going to do anything they can to prop up the market. And who knows? It's just, you can't base anything on fundamentals right now. It's all a game of liquidity. And it's just, whenever the price is just totally removed from fundamentals, man, I hate to short that. Might be better buying puts or doing something with some options if you understand that well. But yeah, I hate to short anything right now. Evolve, thank you for the super chat. What do you think of the Dragon portfolio Chris Cole talks about on Real Vision? And he also has gone over that extensively on Macro Voices as well. So if you guys haven't heard that episode with Chris and Eric and my buddy Patrick, make sure you check that out. I will have real estate too. Let's get Danielle DiMartino Booth on. Yeah, I'd love to get Danielle on. I need to email her. I emailed Rogers and Jim Rickards last week, and Ron Paul. I emailed Ron Paul. So hopefully Jim's assistant emailed me back, and we've set that up for next week. I'm still waiting to hear from Jim Rickards and Ron Paul. Hopefully we'll get them on board. Danielle is fantastic. I think she's amazing. I would love to interview her. So I just need to get some time to figure out the correct contact email address and email her team. As far as the Dragon portfolio, I think it's fantastic. It's tough to debate Chris Cole. That guy is really, really sharp. The only thing about the portfolio is you got to go long volatility, if I understand it correctly. And it's a little hard for the average investor to go long volatility because it involves options. And I mean, if you wanted to do that, of course, you got to start with watching my series with Patrick Ceresna. I'm not sure if you could, I'm just not sure the retail investor could implement his strategy exactly. But as far as the concept of it, I think it's fantastic. And speaking of guys I'd love to get on the show, I'd love to get Chris on. Man, that would be awesome. So I need to remember to email him and Danielle next week. Baxter, thank you for the super chat. Hey, George, how are you playing the Cerveza sickness? I'm not really playing it. I'm just waiting for things to get cheap. And 4 weeks ago when they got really cheap, I bought coal. I bought some oil producers. I bought a bank. I bought the gold miners. I bought uranium. I bought a lot of things, like I said, back when the market was almost at a bottom. And I didn't buy it because I was timing the market. I want to be clear. It's not because I thought, okay, the market's hitting a bottom, I need to go all in right now. Not what I said. I said, is this stuff getting ridiculously cheap right now? The answer was yes, so I bought. And as of right now, I mean, I'm up massively on all of them. I mean, even uranium, I'm up huge. But actually, I'm not up on all of them because I bought the cruise line, and I think I'm down a little bit, a couple percent on that. But most of them, I'm way, way up. But that doesn't mean that I'm selling. I'll probably keep them for 10 years, or I'll at least keep them until they get expensive. So my answer is I don't have a game plan specifically for the cerveza sickness. It's my game plan I have always, and I'm trying to buy stuff when they're cheap. So now I'm a little bit more cognizant of the market because I know that there most likely will be a lot more opportunities in the next year to buy assets at a cheap price. Joseph, thank you for the super chat. With ZERP, 0% interest rate policy, why are mortgage rates still in the 3.5 range on the 30-year? Do you see them in the 2% range? Any thoughts about where rates are heading and when? Well, it gets a little confusing, Joseph, because there are a lot of time. If you look at a chart of interest rates or the Fed funds and a chart of the 10-year, you see that a lot of times those don't go down or up in lockstep. And then if you look at the 10-year compared to mortgage rates, a lot of times they don't go up or down in lockstep. A lot of times they can kind of diverge. I did a video that included a chart a couple weeks ago on that, I remember. So just because interest rates go to zero doesn't mean that mortgage rates will go down. There's a lot of other factors. So let's see, do you see them? I'm guessing you're asking if I see mortgage rates in the 2% range anytime soon. I don't know. Because you've got, I think there's a lot more inflation expectations in the United States than there would be in Europe, where you might be seeing some of those types of mortgage rates, if not lower than 2%. And inflation expectations are going to be a big cross current in the equation, Joseph. Because the government is running not just $1 trillion deficits, but $1 trillion deficits weekly, almost. There's a lot of anxiety about inflation. And as long as the government is running these types of deficits and there's that anxiety, I don't know if you see mortgage rates go down, especially 30-year, too much lower, because who on earth would buy a 30-year fixed rate loan? Who would be your counterparty there, right? Obviously, we know who wants to get the 30-year fixed rate loan at 2%, but who the hell's going to buy it? I don't know. I mean, they definitely can, but I wouldn't. I don't think the probability is extremely high. It wouldn't be my base case. And then any thoughts on where rates are heading? I'm guessing you're talking about Fed funds. I think it's going to be very hard for them to go below the zero bound. Not technically, but from a standpoint of what it would do to the worldwide economy. Also, it's kind of a balancing act. What happens when U.S. debt yields less than European debt or Japanese debt, the other two kind of main competing currencies? I'm not saying that it will, but what happens if it did? Now all of a sudden you're being penalized by holding treasuries compared to JGBs. What does that do to the demand? Does that make interest rates go back up to where there's just a lot of different cross currents there? So I don't know that I have any real definitive convictions on interest rates other than we're staying at the zero bound for, if not lower, in my opinion, for quite a while. They're now that the balance sheet is going to 10 trillion, 20 trillion, and that these deficits are just going to the moon, they're not going to be able to raise interest rates. So ZERP for a long time coming. That would be my final answer. Linda, thank you for the super chat. And I'm guessing we've got no more super chat. Oh, let me go back to this, Linda. Oh gosh, yeah. Oh my gosh. Jeez, I do this every time. Yeah, Sebastian, no more super chats. Holy cow. I think I've been taking a long time on every answer today, which is great. I really enjoy doing that and answering the questions as thoroughly as I can. And I try to think through my answers, as you guys can tell. These aren't pre-canned answers, but boy, I've got a lot to do today. So Sebastian, no more super chats, buddy. All right, Linda, thank you for the super chat. Is it still a good idea to sell your house if you are in a cyclical market and you have decent equity? What do you do with the dollars not to lose value? Gold and silver are scarce. Yeah, but you can still get it, Linda, I think. If it were me, I wouldn't want to have a house right now in a cyclical market. Boy, your downside is, you got some big downside there. And yes, there is an argument like for still having some upside because there's a very low supply. But boy, the asymmetry, I think, is what you got to look out for. We want asymmetry where our upside is greater than our downside. And I think in real estate and cyclical markets right now, it's the opposite asymmetry. Your downside is a lot greater than your upside. So I personally would be a seller here. And so what do you do with the equity? I'd keep a lot of dry powder. I'd try to find some things that are cheap. They're going to pay you to own them. And I'd start looking at real estate in linear markets to use as cash flow, but I would not pull the trigger unless you just got a smoking deal. Like if you could buy something at like 2012 prices or 2012 cash flow, I'd pull the trigger. But if you can't find a smoking deal, I'd probably hold off and just kind of see how things play out with the cerveza sickness, and if we're going to get a second wave or a third wave, or who knows what happens. And keep in mind, guys, back in 2008, it's not like the whole system collapsed overnight. You had long periods, I mean, months, where people thought, okay, that's behind us. Subprime is contained. No worries. You know, we went, well, look, there was what, 3 or 4 months between Bear Stearns and Lehman. A lot can happen in 3 or 4 months. So I think that's my main advice. I would, if it were me, and I can't give personal investment advice because I don't know your situation, but if it were me, I would sell. I would take the equity. I'd keep that powder dry. I'd put 10% in gold. I'd try to find some good dividend paying stocks that were really cheap right now. Like the ones I bought were like Shell and whatnot, but I'm not saying that's right for you. But I'd do that. But I'd mostly keep a lot of dry powder. I'd start looking for opportunities in linear markets, but I wouldn't pull the trigger unless I just had a smoking deal. I'd be very patient. I'd just assume that time is on my side. Free Thinker, thank you for the super chat. How will the deflation dollar spike period end? If it spikes high enough, I think it will end in a Plaza Accord 2.0. I talked about this with Brent Johnson, Groman, and Snyder on Saturday about this. Do we see a Plaza Accord 2.0? If so, how does that work? How would it play out? If the DXY gets up to 120, 130, it's going to cause too much pain, not just for the United States, but for the world economy. So that's how, if the dollar does spike, that's how I see it playing out. Just a Plaza Accord 2.0. And what I mean by that is some sort of central bank intervention to artificially lower the value of the dollar. For Kiddo, thank you for the super chat. Next week is arguably going to be one of the most important weeks in the stock market ever. Facebook, Google, Amazon, Microsoft, all reporting, and will shock the markets. Next wave of sell-off starting, including gold and gold stocks, question mark. I don't know. I don't think there's any bad news as far as quarterly earnings or the unemployment rate that isn't already baked into the market. I'm not saying that's right. I'm not saying the market is analyzing it properly. I'm just saying I think that's probably baked in. I think what's not baked in is a second wave of the cerveza sickness. So the market, I think, believes that Trump or XYZ local government is just going to open up and, oh, thank goodness, that cerveza sickness, oh my, that's gone. We don't have to worry about that anymore. It's in the rearview mirror. We can go back to the nightclubs. We can go back to the movie theaters, to the gym. We can just start spending money. We go right back to the job we had that we lost a month ago. And we never have to worry about that stupid cerveza sickness anymore. The economy is going to boom because all of this stimulus that the government has done, and because of the accommodative stance the Fed has taken with all the 4-letter and 5-letter programs you guys know about well. In my opinion, that's the main sentiment in the marketplace right now. That's being baked in. So you just got to write off 2020, and 2021 will be right back to normal. So just disregard the numbers for anything we hear right now. What's not baked in is if we open back up and in a month's time we see the growth curve in the cerveza sickness as far as the rate of contraction within the overall population, and more specifically, if you have these kind of hot pockets like New York that are just really going nuts. If we open back up, and trust me, if we open back up, we're not going back to normal. The behavior might go back to where it feels more like a normal life, but there's so many jobs that have been destroyed and that were propped up by funny money and debt. And those jobs aren't coming back anytime soon. That's not like a light switch. So the unemployment rate is going to be high for a long time. But if we have that second wave where we see the cases of the cerveza sickness start going up exponentially again after 2 months, in my opinion, the market is not factoring that into the equation. If we have that, that's when we have the second wave down. Or what could happen is we could see a lot of systemic risk in some bankruptcies that the Fed might not be able to prevent. I know they're trying to prevent every single bankruptcy right now, but it's just like this. It's like the beginning scene of Ice Age. Remember that cartoon? I don't even know what animal it was, but remember he was on that iceberg or something, and he's holding on to it like this, and every time water shoots out, he puts his finger on it, and his thumb on it, and his toe on it, and he's got his elbow on it, and he's got his forehead on it. That's just what the Fed's doing right now with the market. So sooner or later, it's likely that one of those streams of water is going to shoot out, and the Fed is going to miss it with their elbow. So what happens? What type of systemic risk is there with the bankruptcy of whatever entity that is? I don't know. but most likely the market isn't taking it into consideration. My point is, I think a second wave of the coronavirus or an unexpected bankruptcy that has a lot of systemic risk could blindside the market, and that's what takes us to the next downtrend in the S&P. I don't really think it's going to be because of earnings. Range, thank you, Range 2300. Thank you for the super chat. Hi, George. Thanks for some awesome macro advice. Good vibes. What is your advice for creating a successful YouTube channel? Start, number one. Just start. And I know that sounds funny, but I'm actually being serious. So many people try to analyze what they should be doing and how they're going to set up their videos, and they just get the paralysis of analysis when you really can't predict all of the variables. So you just got to start producing content, no matter how bad it is. You just got to start doing it. I mean, look at my videos. I go back when the live stream's done and look at the first videos that I did. I mean, they're terrible. They're terrible. Now, that said, I was just playing around, and the editors were working on the TV show back then. So once they started working on the YouTube channel, the videos got a lot better. And you can see the where they started working on the YouTube channel is when we get to the very first real estate vlog. And it's the one where I went to Fashion Week here in Medellin. And if you guys are interested in vlog, I mean, I never really talk about them at all. But if you guys are interested in seeing me in a more like a vlog type setting, we've got like 6 or 7 episodes currently right now on the YouTube channel. They're just like 8 months old. So you've got to sort the videos by age, and then you'll see those real estate vlogs that I was doing, which are really, they're a lot of fun. They were great editing. But that's a great point. See, now I'm not doing any real estate vlogs. Why? Because no one wanted to watch them. So I just kept iterating and kept changing things up until you see what works and what doesn't work, or what people enjoy watching and what people don't enjoy. And you do just more of what people enjoy. Now, I'm extremely lucky from the standpoint that I know real estate extremely well. And I also know macro. I understand how macro works, but I enjoy talking about macro far more than I enjoy talking about real estate. Real estate, it's fun every once in a while, but that's not really what gets my juices going. I really like talking about macro, as you guys can tell. So it just worked out perfectly that you guys enjoy watching what I like talking about. But it didn't start that way. The channel started as just real estate investing stuff. And you just keep iterating, and you just keep throwing stuff. You even look at the way we edited. I mean, we were trying some crazy stuff in the edits. Crazy stuff. And a lot of the editing tactics we tried just were terrible. I mean, they just flopped. And I could see in the comments, people were like, stop using that stupid bell. I hate it. Well, you just don't do that anymore. People say, stop cutting so much. Just show the whiteboard. I just want to see the whiteboard. So you stop cutting so much. You just show the whiteboard. It's so you've got to keep an open mind, and you've got to, but in the same token, you got to filter out the noise. Because to this day, I get comments where people will say something that I've got to be like, okay, well, I got to kind of take that one with a grain of salt. Like the other day, I got this comment where someone was just demanding that I change the background for the YouTube video, that the color was just way too purple. I'm like, okay, well, I appreciate your feedback, but I'm probably not gonna make that change. But if you got a lot of people in the comments saying, hey, I hate this, or hey, I like this, you just got to pay attention to that. And so you're always iterating. You combine that with the back end analytics that YouTube provides for you. So For those of you who don't have a YouTube channel, if you go to a video, you can see how long people stay. It's a retention rate. You can see how long people watch the video on average. So a 10-minute video, do people watch it for 6 minutes on average? Do they watch it 8 minutes on average? And so you get graphs and charts and data on the back end. The click-through rates, the thumbnails, that's another great example. So YouTube gives you analytics on what percentage of the people see your video and actually click on it. They call it a click-through rate. So then you can determine how well your thumbnails are working. So if you guys go back to my early videos, I didn't have a big George bobblehead on there. Nothing like that. I just had like normal kind of just your typical thumbnails. But I found, and I don't know why I started doing the bobblehead. I probably started doing it just because I thought it looked funny. And then I found that my click-through rate went up substantially when I used the bobblehead thing, because it's just different, I think. And people are scrolling through their YouTube feed on their phone, and what is this bobblehead? The quantitative easing bobble. What is this? And it just gets their attention really quick enough to just read the title. And then if they're interested in the title, then they can go ahead and they click on the video, and there you go. And then if they watch that video longer than other videos that rank for the same keywords, then YouTube is going to take your video and promote it to more and more people. And that's how your channel grows. So with the retention rate, as an example, I would do a video, and then the next day or the next week, I'd do something with a completely different edit. And I'd see where my retention rates were. And then I'd just let the numbers tell me what I need to do. And to this day, I still look at the retention rates of the videos, especially on those longer ones, because I get a very uneasy, when I've got a video that's like a half hour, I'm like, oh, great. Because I honestly, I try to keep the videos around 15 minutes or so. But sometimes I just can't explain everything to the best of my ability in 15 minutes. So I'm like, oh shoot, it's going to be 30 minutes. But then I'm on that retention rate like a hawk, trying to say, okay, how much did this affect the retention rate? And a lot of times on those videos, fortunately, the retention rate doesn't go down by much, because you guys are fantastic and you're willing to allocate more of your time to watching my videos. So it goes back to the community. I really appreciate you guys doing that. But my point is, you got to iterate. You got to start, number one. You got to iterate, and you got to pay attention to your back end analytics. And places where I learned a lot, just free information. Miles Beckler, number one. Video creators, they do a fantastic job. Video influencers is another YouTube channel. These are all names of YouTube channels. Daryl Eves is another YouTube expert. Nick Nimmin is another, and Brian G. Johnson. I don't know. I gave you 5 or 6. So and they're just free YouTube channels. And that's where I really learned how to analyze those back end analytics that really helped the channel grow to what it is today, and hopefully will help it grow to the next level. I don't know if you guys saw the 100,000 subscriber live stream we did, but my next goal, although it may sound crazy, is 1 million subscribers. So I think it's tough to do in this space because it is such a narrow niche, just this kind of macro topic. But Mike Maloney has 500 or almost 600. So I think if Mike Maloney can get 500 or 600, I can get 1 million. I mean, maybe that's just kind of the way I think. Maybe I'm right or wrong. Maybe that's why I took so much risk as an entrepreneur, probably. But I just think that, and not that I've got a tremendous amount of respect for Mike, don't get me wrong. But that's just kind of how I view things. If I see someone doing a YouTube channel, it doesn't matter anything. If I see someone doing it well, just my default is I think I can do it better. And who knows whether I'm right or wrong, but that's just the way I see it in my mind. So that's the next step, 1 million subscribers. Okay, B3 Wrangler. Thank you for the super chat. Hey, George, I love the whiteboards. You're a great educator. Can you tell us why you chose to move to Columbia? Well, to be clear, I didn't really move anywhere. I don't like that much of a commitment. When I retired in 2012, one of the main reasons I did is because I kind of built these monsters, these businesses that I became a slave to. And I didn't have any freedom. I couldn't choose where to go, or I couldn't choose where I wanted to be, and I couldn't choose what I wanted to do. And so to this day, I'm very cognizant of making sure, even with this YouTube channel, that I'm setting it up in a way where it's not restricting where I physically have to be, because then what's the difference? Why did I retire in the first place, right? So my point is that I don't like to say that I live in Colombia, because 6 months from now, I could be in Montenegro. I could be in Croatia. I could be in South Africa. There's a lot of places in the world where I enjoy spending time. Or Puerto Rico. I mean, I'm going to be spending a lot more time in the future in Puerto Rico, just FYI. So I don't know that I've chosen to live here. Now, why I chose to invest here and to spend time here, that's a different question. So originally I chose to invest here because the price of oil was really cheap. So the peso got cheap. And I didn't know how to invest in oil at the time. But what I did know is how to invest in real estate. So I thought this was back in 2014, 2015. So I thought, okay, if I can come in and buy a peso denominated asset that I understand, that gives me a way to play oil without getting involved in a market where I'm probably going to get clobbered because I don't know what I'm doing. So that was the motivation originally. And that was back when I first started and the first project I did here was just huge project. It was probably 6,000 square foot property. But that's not the point. The point is that's why I came to Colombia and looked at it as an investment opportunity initially. And then once I started spending time here, I'm like, my goodness, this is one of the most awesome places I've ever been in my life. The weather is perfect. They call it the Valley of Eternal Spring. The people are fantastic, just so nice, so much energy. I mean, you go out to a cafe or even a dinner place at 8 o'clock in the evening, and if people hear a song like a salsa song that they like playing over the radio, everyone will get up and dance, and it's just a fantastic atmosphere. The food is wonderful. The cost of living is just a fraction of what it is in the United States. So what's not to like? So that's why I ended up spending time here, and why I've spent call it 3 to 6 months a year here since 2015. 2019, I spent the majority of the year here because of the TV show and because of the YouTube channel. But this year, I might not spend more than 6 months here. I'm not sure. It all depends on the cerveza sickness. But that's why I started investing here originally, and that's why I choose to continue to spend a lot of my time here. Musab, thank you for the super chat. Hey, George, what's your take on Tesla and Uber in 0% interest rate policy days? Do you think they will lead the future? Sentiments are quite bullish. I love the companies as a service and a car. I always use Uber. Always use Uber. Wherever I am in the world, I'm using Uber. So I love the service, but that doesn't mean that I'd invest in the company. Those are two completely separate questions. Same thing with Tesla. I think I don't really like the Model 3. I think it looks kind of weird, but I love the Model S. I mean, really cool car. I mean, look at the acceleration. What, like 0 to 60 in 2.3 seconds, is it? I mean, it does the quarter in like mid-10s. That's insane. That is crazy fast. So I think the car is really cool, but it doesn't mean that I like the stock. The stock is just crazy, crazy valuation when you think about a company that has never made a profit. I did a tweet today, and in the last, I don't know what it was, since 2013, so the last 7 years, Tesla has lost over $6 billion, and they've never turned an annual profit. I don't want anything to do with that. That doesn't even fit my speculation, the speculation side of my portfolio, because in no way, shape, or form can that be considered cheap. No way. You can't buy a company that doesn't make money and say that you're buying a cheap stock. There's no way. Anyway, that's my thought on Tesla and Uber. I think it's a great car. I think it's a really awesome service, but I don't like the stock. And at these prices, there's no way I'd buy it. Micro Business Media, thank you for the super chat. Your financial education has changed lives, George. Thank you very much. I appreciate you saying that. Very kind of you. What will investing look like after the reset or the crisis? Do you think the average person will have any vehicles for building wealth? As far as how I see investing after the reset, the exact same way I see it now. Just you're trying to figure out, based on cash flows and historic prices adjusted for inflation, what's cheap and what's expensive. Now, that said, there will probably be different things, cheap and expensive, but it doesn't really change the mindset. As far as the average person, I hate to even say it, but I just don't. Yeah, it just goes every single time we go through a crisis. The average Joe and Jane, they get the short end of the stick, just every single time, and I just hate it. I cannot stand it, and it's all a result of what the Fed has done: artificially low interest rates, money printing, inflation. It's all a result of these things that I just cannot stand. And the rich just get richer, the poor get poorer, the middle class gets completely hollowed out, and unfortunately, the central banks and the mainstream media just don't understand the reason why. And if they do understand the reason why, they're not willing to change. So my point is, I think the average Joe and Jane will have fewer resources at their disposal after the crisis. And it just really sucks to say that, but that's just history, really, unfortunately. Alexi, thank you for the super chat. I'm 37, considering withdrawing from 401k while CARES Act allows penalty-free withdrawal. Ooh, I didn't know that. I plan to pay off debt, buy Bitcoin, and a laundromat. Any thoughts? It depends what type of debt you're talking about, Alexi. I'm assuming you're talking about consumer debt. And if you're talking about consumer debt, I think that's a very wise decision. Bravo. If by chance you're talking about debt that you have on an asset that is cash flow positive, a productive asset, and especially if you've got a fixed rate mortgage, like 30-year, I don't know if I'd pay off the debt. I'd, as long as it's productive debt and fixed rate, I would hold on to that. Again, to be clear, if it's consumer debt, pay it off. That does you no good at all. Get rid of it. As far as Bitcoin, I think Bitcoin could be good. I definitely make sure you buy some gold there, but I wouldn't allocate too much of your portfolio to Bitcoin. But I think there's great asymmetry. As far as a laundromat, that's a tough question because laundromats, it's such a micro analysis in the sense that you've got to find out, like, where is it? Is there a college near? Is it by an apartment complex? Is there opportunity? How are the building codes there? Could someone set up a laundromat right across the street? There's a lot that goes into it. I've looked into laundromats before, and it's too much of a macro decision to give you an answer just over a live stream on YouTube. What I will say is, from a macro standpoint, I think a laundromat's a great investment because most likely the economy is going to struggle over the next few years. And if we do get inflation, price inflation, you are going to be a price maker and not a price taker. So you will have the ability to continually go from $1 to $1.25 to $1.50 to whatever in your laundromat. And I like that. And I like laundromats because they are relatively recession proof. So from a macro standpoint, I think you're headed in the right direction. As far as, but the micro analysis, I can't give you any advice there because it's just so specific and case by case. Shotgun, thank you for the super chat. I am 36-year-old Air Force nurse. Okay, very cool. Thank you for being a part of the Air Force. My father was in the Air Force in World War II, believe it or not. With little debt, let's see. Let me see. I think this is worded a little weird here. Let me try to make sure I'm understanding your question. 36-year-old Air Force nurse with little debt beside my house in Vegas. I'm not an entrepreneur by nature. Do you have any good suggestions on how I can leverage to start a business? Yeah, you got to look at Miles Beckler. You got to look at his stuff. Go to his YouTube channel, just his name, all free. He gives it away. And he is just money. I mean, he is right. He just nails it. So, and go back to his earliest videos. He started I think 3 years ago. So when you go to someone's homepage, you click on the videos, and on the right, there's like a sort thing. Click on the sort thing, and it allows you to sort by the most recent videos, the most popular videos, and then the oldest videos. Go ahead and check on the oldest videos and go back and I would just power watch, binge watch Miles content, and then it'll get the wheels turning, and you'll be like, oh, I see how this works. Oh, I never thought of that. Oh, that's a great idea. Well, I could do this, this, and this. And I guarantee you, if you have a skill set of being a nurse, you could do some really awesome stuff with content creation, and then it just goes back to your personality. Like, are you someone who's more comfortable with blogs? Are you someone who's more like writing? Are you someone who's more comfortable just talking through like podcasts? Or are you someone like me who just doesn't care what anyone thinks of them whatsoever? So I'm perfectly comfortable making an ass out of myself at all times. So video is perfect for me, but I'm really not a good writer. I don't like writing at all. And but Miles talks about that. He talks about a 3-pillar content strategy where you're just good at one pillar, whether it's video, audio, or written, and then you take the content from the pillar that you like the most. So for my case, it would be YouTube. and then you take that content and try to repurpose it for a blog and repurpose it for a podcast. So as most of you know, I've got a podcast, The Rebel Capitalist Show, on iTunes or Stitcher or any of those. And we're just ripping the audio from the interviews and from the live streams like this. I got that idea from Miles. Miles talked about it in one of his videos. I'm like, oh, exactly. Why do I not have a podcast right now? I'm already doing the content. All Thomas or Danny has to do, my editors just rip it, and then Sebastian turns it into a podcast real quick. Done. Right now, I've hired someone to do the exact same thing with the website and the blogs, to take the like a whiteboard video or an interview with like Peter Schiff or Jim Rogers and turn that into an actual blog post. So my point is if you've got the skill set of being a nurse, you've got tons and tons of niches that you could go into where you could provide a lot of value. So just start with Miles Beckler. H.J. Kane, thank you for the super chat. Hi, Oh, okay. I'm sorry. I thought that said monkey. Geez. We're going a little long here, guys. You'll have to forgive me. My brain is checking out. H.J. Kane says, hi, I've got some money locked into an IRA and got the gold miners, but what about silver miners? Mike Maloney is buying silver because of the gold-silver ratio, but what gold-silver ETFs would you recommend? I like silver miners and I like gold miners. I bought silver miners the other day just because I was a little more comfortable with them. But I think silver is super cheap right now. I think the silver miners are a great play. One thing I'm a little concerned with the silver miners is if you go back to my interview with Rick Rule, he mentioned that it's tough to find a pure silver play in a mine because generally silver is mined as a byproduct from mining something else, where the gold miners are just pure plays. That's why I kind of prefer the gold miners. But I'm totally see your point with silver, and I see Mike's point with silver as well. I just see gold, the physical gold and silver, as two different asset classes. I see silver as a speculation and gold more as insurance. And I know silver historically has been a store of value, but it's just got some industrial components to it. So just me, I like to be super conservative with my with the insurance side of my portfolio. So I just stick with gold. As far as gold, silver ETFs, I would recommend. Well, I like, with the research I did, I liked the Sprott products. And because number one, I've got a lot of respect and I trust Rick Rule tremendously. Not only did I do the interview with him, but before the interview and after the video or after the interview, you talk to the guys just kind of more on a personal level. And let me tell you a story about Rick Rule. And this is, and it's always the little things, right, that really form your opinion on someone as far as how trustworthy they are. And you got to remember, when I interviewed Rick Rule, the channel didn't have a lot of subscribers, didn't have 100,000, maybe had like 30 or 40,000. It was quite a few months ago. So I was relatively unknown. So number one, Rick was nice enough to do the interview. Number two, when we got done with the interview, a couple days later, I got an email from Rick's assistant. And Rick's assistant was asking me for my physical address. And I was like, okay, sure. Shoot, what did I do wrong? That was the first thing that came to my mind. I was like, oh man, what did I do wrong? I must have screwed up something. And so I told them I was out of the country. So I gave them my sister's physical address in Dallas. Week and a half goes by, something like that. And my sister calls me up and she says, "Hey, you just got a package from Rick Rule." And I'm like, "Wow, you're kidding me." She's like, "Yeah." I go, "Okay, open it up." So she put me on video chat or whatever on WhatsApp, and she opened it up, and sure enough, Rick sent me like a gift basket of like chocolates as a thank you for having him on as an interview guest. That tells you about the type of character Rick Rule has right there. I mean, how many people do that? And not only that, I should be thanking Rick Rule, for heaven's sakes. And then he goes out of his way to have his assistant do that for just this unknown guy on YouTube just to say thank you for the interview. That tells you a lot about Mr. Rick Rule. So that's and quite honestly, guys, as an entrepreneur, I'm someone that made a lot of money or lost a lot of money based on my ability to judge people's character. And so maybe I put a little bit too much priority on things like that. But to me, that makes me very comfortable buying a product that Rick Rule is associated with. Oh boy, here's this person's name again. Vela Horayu. And again, I'm sure I'm butchering that. I apologize, but thank you for the super chat again. So I'm afraid to invest in crypto because it seems that Tether is pumping up the price of Bitcoin. It's probably just printing its own funny money, just like the Fed. If you look into it, please let me know. I will for sure. And the way I attack crypto is it's so nuanced that I don't think I could ever understand as much as I need to. So I try to interview guys and gals that know a lot more than I do. So in the future, I'm definitely going to be interviewing more crypto people, and to help educate me as long. Sorry, guys, my brain's going south here. I'm gonna have more crypto people on to help educate me as well as the audience, and just kind of take you along on that journey. Same thing I did with options with Patrick. I mean, that's such an esoteric topic, and there's so much to know. I mean, it'd take me a months, years to try to figure it all out to where I could explain it to you guys thoroughly. Where I could just have my buddy Patrick on, someone who I trust a lot as far as their level of competence, and have him explain it to me so I can learn. And again, just take you guys through that journey, and hopefully that provides a lot of value. Daniel, thank you for the super chat. Which of your video... Okay, so this is worded a little weird here, but if I'm understanding you, Daniel, you're saying which of your videos or which type of videos that you have are the best for monetization, and do the live streams perform better, or do the recorded whiteboard videos perform better? It's pretty much a wash, Daniel, because although you have the super chats from the live streams, the whiteboard videos get so many more views, and the CPM on the whiteboard videos is a lot higher for some reason. I haven't figured that out. And just so you guys know, the CPM is the price per million, or excuse me, per 1,000 views YouTube pays the YouTube creator. Or excuse me, I think it's the advertiser pays YouTube, and then YouTube does a split with the creator. So as an example, like a whiteboard video I do can get a CPM of like $10. So $10 per 1,000 views. That's really good. Where the CPM on a live stream, or even an interview, which is weird. Even the interviews, the CPMs are lower, maybe like $6 or $7. So it's just what that's telling you is that the advertisers are willing to pay more for one of those whiteboard videos than they're willing to pay for an interview. Maybe they feel as though the engagement is higher on a whiteboard video. And then, of course, the whiteboard videos get a lot more views. Usually they get about double the views as an interview. So you've got a higher CPM, and those whiteboard videos get a lot more views, but of course they don't have the super chat. So when you compare the two, it's pretty much a wash. And I know a lot of people like YouTube videos where the YouTuber gives specific numbers, and I have no problem doing that. Right now, the YouTube channel is generating YouTube AdSense or ad dollars. It generates about $7,000 a month in revenue from the ad split with YouTube. So keep in mind, I've got payroll. It's not like 100% of that is going into my back pocket. I've got a staff of 5 or 6 people that I have to pay. So at the end of the day, you don't end up making too much money from the ad stuff. But that's what the channel is generating right now, about $7,000 a month. And that's based on about 1.8 million views per month. Oh, one other thing too on that is I don't do what they call mid-roll advertisements. Like Graham and Kevin, they do mid-roll stuff. So their CPM is going to be way higher than mine. I mean, they'll probably have a $15, $17 CPM because they're doing mid-roll. So I've chosen not to do the mid-roll. So my point with that is don't think that, oh my gosh, I could, if I don't have 1.8 million views, I'm not going to make 5 or 6 grand. It's not going to be worth my time. That's not true. If you had a lot fewer views but did mid-roll, and you could make the same amount of money. So just keep that in mind. Chris, thank you for the super chat. In case of hyperinflation, is there a mechanism in the U.S. to force employers to increase wages? I've lived through it, and that wasn't the case. I don't think so. You've just got the minimum wage, and I don't think so. And Chris, that's a great point. That's why hyperinflation is so destructive to, well, any type of inflation is so destructive to the average person, because their wages just aren't going to go up at the same, or their wages are going to go up a lot slower than the rate of inflation, or their wages will always be behind the curve, where the people who are getting the money, all the government cronies and the Jamie Dimons of the world and the Black Rocks of the world and all those entities and people that are just, have the Fed on speed dial, they're the ones that get the money and spend it and get the benefit of the funny money before it translates into more inflation. And it's just the way it works. Shotgun, thank you for the super chat. I read Real Vision Unfolding, where they talk about the collapse of fiat currency. If collapse of the dollar isn't the investing in the market terrible idea. Wait a minute here. If collapse of the dollar investing in the market is a terrible idea. Oh, I see what you're saying. If the dollar is going to collapse, isn't investing in the market a terrible idea? You kind of have to ask the question, compared to what? Compared to bonds? No. Investing in the market's a fantastic idea. Because in a fixed income instrument, you're just going to get crushed with a collapse of the dollar, because you're getting paid back in dollars. At least the market will go up a little bit. It might not go up, or it most likely wouldn't go up in real terms, but at least in nominal terms, it's going up. That said, compared to gold, it's not going to be as good. Compared to gold miners, it's not going to be as good. Compared to real estate, linear, certain real estate, it probably wouldn't be as good. So, but I don't know if I would use that in my decision-making process, because again, you're trying to ask yourself, are prices going up or down? And I know I'm beating this like a dead horse, but I think it's worth doing because it's so important. You're trying, it seems like you're trying to say, okay, well, I don't want to invest in the market right now because it's going down. The market will go down because of hyperinflation. I just wouldn't start there. I would start by asking myself if the particular stock I'm looking at is cheap. And if it's cheap, I'm going to buy it. And I'm not really going to concern myself with what the dollar collapse is going to do to the market more broadly. That said, we've got to go back to my main rules of investing, which are of now just strictly investing. You've got to buy it when it's cheap. It has to pay you to own it, and you have to diversify not only your portfolio but your political risk and your currency risk. So if you're paying attention to all of those rules and you're implementing them in your portfolio, I think that you might not get rich in an inflationary or hyperinflationary or in a devaluation of the fiat currency, but you're going to at least maintain your purchasing power, which right now in the world we live in is probably should be your main objective. Oh, wow. Oh my gosh. I cannot believe the super chats. Well, guys, I mean, I'm humbled by how many questions you guys ask. It's just, I really appreciate it. And it's just amazing that you guys would respect my opinion that much. Thank you very much. But we've got to stop the super chats. I've got Sebastian on, and it's his day off, and I've got to be cognizant of that. And I've got a lot of work to do, and I got to eat lunch. But I'm gonna get through all the super chats. Don't worry, I'm gonna get through all of them. So Joseph, thank you for the super chat. Really love the channel, George. Thank you, Joseph. I'm curious what resources you personally use to learn econ and finance. I started with the Free to Choose series by Milton Friedman. I remember where I was. I was in the Marina Bay Sands in my hotel room in 2012. I had about 10 minutes to blow before a dinner date, and I was browsing YouTube, and I came across Friedman's I had no idea who Milton Friedman was. I didn't know what the Fed was. I really didn't understand interest rates. I didn't know the first thing about economics. And that just took me straight down the rabbit hole. Then from there, I went to Thomas Sowell. Then from there, I started studying guys like Jim Rogers. I had read the Market Wizards books, so I understood trading psychology because of my background in blackjack. But as far as a macro, didn't know anything. So that's kind of where I went down the rabbit hole. So I just started with YouTube videos of Jim Rogers, Mark Faber, Jim Grant, Peter Schiff, podcasts, anything I could absorb. I just got obsessed, just 24/7. And then audiobooks. So I like the format of podcasts better. So I preferred podcasts, but it really was all about audiobooks, podcasts, and YouTube videos. That's it. I never took a class. I've never taken an econ class or a finance class. As most of you know, I almost flunked out of high school. So it definitely wasn't anything academic. Or I had no one in my family had ever been into economics. So it wasn't, it was completely cold turkey and self-taught. Oh, now so some resources that I currently use, which would probably be more applicable, Joseph, would be Real Vision for sure, Macro Voices. I listen to Shift's podcast all the time. I listen to the Investors podcast with Preston and Stig. I listen to several in that QTR, my buddy Chris. I listen to him because he's just so damn entertaining. I love Chris. He's just a fun guy he should do stand-up comedy. I mean, he really should. I always tell him that. But and then I always watch my buddy Jason Burrick on YouTube. His videos are great, but that's really where I'd start right now. Food service. Thank you for the super chat. Or food service pod. So maybe you have a podcast, a food service podcast. Make sure I want to give you the plug there. You mentioned rolling PHYS into physical gold. I'm looking to do the same thing. Okay. Where should someone in the U.S. buy physical gold? I can't tell you where to buy. You got to go with who you trust. And that's going to be a very individual decision. I mean, Rick, Schiff, Mike Maloney, Lynette, I think they all have some sort of physical gold product. I think you just have to do the research and find who you're most comfortable with and what prices they're charging, and then just go that route. That's what I do. I tell you what, in the future, when I do roll it over, I'm more than happy to tell you which physical gold company I use. So I'll definitely do that in the future. Zero Hero, thank you for the super chat. Would love to see you interview Ray Dalio. So would I. I would love to see me interview Ray Dalio. Hopefully. I know it seems like Ray is trying to reach out to a more broad community by doing YouTube videos himself. So I'd love to get him on, and I'll definitely give it a shot. I have no problem someone telling me no, that's for sure. I've got no shame. And I'll reach out to other guys too that might be kind of unattainable. I'll definitely reach out to Kyle Bass, Ray Dalio, and why not? The worst thing they can do is tell me no, right? That said, just as a reminder, if you're just tuning in here, next week I'm interviewing Jim Rogers. So we're getting close to the Ray Dalios there. And the week after, I'm interviewing Robert Kiyosaki from Rich Dad, Poor Dad. So we're definitely getting into the realm of people who are maybe not any more knowledgeable, but definitely more famous. And I can't wait to interview both those guys. Obviously, I've got a huge amount of respect. Jim Rogers is my favorite investor of all time. And then as someone who tries to break complex topics down into a format that everyone can understand, there's no person that's done that better than Robert Kiyosaki. I mean, he is the OG with Rich Dad, Poor Dad. So I'm super excited to interview him as well. And just so you know, Robert was nice enough to invite me to do his show, the Rich Dad Radio Show. So next week, I'll be interviewing Robert, and then I'll be going on Robert's show as well. Billy, thank you for the super chat. George, how would you suggest someone build a portfolio? I own a small business and want to get I'm assuming you're saying, and you want to get into real estate. Thank you. Okay, Billy, I would first, let me suggest another podcast. I would start listening to my good buddy, Jason Hartman. He's got a podcast. I think it's the best in the real estate space. It's called the Creating Wealth Show. He's got well over 1,000 episodes. I would do that. I would listen to the Bigger Pockets podcast. I think the real estate guys are great. And I like the real estate guys too, because they've got a better understanding of macro than the Bigger Pockets guys. But the Bigger Pockets, it's just fantastic content. So I would listen to those 3 podcasts first and foremost. And then I would start researching linear markets. I would go to Jason's website, jasonhartman.com, and I would look at which linear markets he's involved with, and I'd kind of use him as a guinea pig. Meaning, okay, if Jason's in this market, he's done some due diligence there, so maybe it's one that I should consider. That's pretty much how I'd start. And by the way, that is how I started back in 2012, just by diving into macro, understanding the whole environment, and then just listening to as many podcasts on real estate investing as I could. And Jason's was one of the first podcasts that I listened to in real estate. And I owe a lot of my success to Mr. Hartman. Niels, thank you for the super chat. Hi, George. Love your channel. Any thoughts on Kitco's Vault Chain, a blockchain-based gold and silver trading platform that guarantees conversion into physical gold and silver? I have not heard about that, Niels, but it sounds really cool. I know a lot of the people in the gold space are doing some creative things with the blockchain and with technology. I know Schiff was saying on his podcast the other day that he's even offering, he isn't doing it now, but in the future, he's trying to get through the regulatory hurdles of offering gold-backed, I believe it was checking accounts at his bank. So I haven't looked into it, Niels, but I think it sounds great. Eric, thank you for the super chat. Says $200K to invest. Thinking of the following: 25% dividend stocks, 8% growth stocks, 24% international ETFs, 15% commodities, rest in cash or gunslinger, cash and Bitcoin. Well, I'd start with 10% in physical gold, Eric. So that would be 20. So that leaves you with 180. It depends on if the international ETFs are, if you're getting dividends from your international stocks. I'd look at if you had 8% in growth stocks, which I don't really like because they're not cheap, but if you like them, that's fine. I would make sure I'm doing anything over 8%, because you don't want more than 10% of your portfolio. At least I don't want more than 10% of my portfolio in speculative plays, which a growth stock would definitely be speculative. So then you've got an extra 2% in speculation, and then you're going into commodities. But see, now you've got, I would say that I've got too much of my portfolio in speculation, unless you're buying commodity stocks which are paying you a dividend. So that's how I'd start looking at your portfolio. Is I'd say if I want to have 15% exposure to commodities and I already have 10% of my portfolio allocated to speculation, then I need to make sure the 15% in commodities is in a stock that's going to pay me to own it. And with the cash, I think that's a great idea right now to have some dry powder. And then Bitcoin, a speculation as well. So maybe you want to allocate 1 or 2% of your portfolio to Bitcoin to get you up to the 10% level for the speculative compartment. I think in 2 minutes, I think that's probably the best way I can analyze your portfolio. Eric. James, thank you for the super chat. What oil stocks do you like right now? I nibbled on some Shell last week, thinking long-term, 5-10 years. Good. I'm doing the same thing, James. Also, what about shorting Discover Capital One? No, I don't like shorting, James, because you just don't know what the Fed's going to do, and it's just not based on fundamentals anymore. So I really get apprehensive when it comes to shorting because, I mean, the Fed could come in and buy all their debt, or who knows. As far as the oil, yeah, I bought Shell like when the market really went down 4 or 5 weeks ago. And I'm not buying it right now, but it's getting close to kind of those same levels. So if it goes lower than where I bought the other day, I'll definitely keep buying. As far as what else I bought Shell and I bought Exxon, but I bought a lot more Shell than Exxon. But I think the main thing here is if you're holding on to Shell for like 10 years plus and you don't care if they don't have a dividend for like a year or so, which sounds like you've got the same strategy I do. I think Shell at these levels, or if you can get it a little bit cheaper, I think personally, I'm buying it. So that tells you pretty much all you need to know. But I'm not going all in. I'm not taking all my cash and just buying it up. As you can tell, I've got a lot of dry powder, and I'm just totally, if I miss out on an opportunity because I don't buy at the right time and err on the side of being more conservative, I'm totally okay with that. Totally okay with that. Because I don't really invest to get rich. I think that's a mistake to have that mindset. Now, I think, ironically enough, if you invest just to stay rich instead of get rich, ironically, over the long term, I think you're going to get rich. It's just a shift in the mindset, if that makes sense. KP Singh, thank you for the super chat. Your take on Barrick, Newmont, GDX, GDXJ, and Shell. I had 100,000 in Barrick, 100,000 in GDX, GDXJ, 200K in Shell. Any better options? I don't think so. Nope. I don't think so. I mean, I'm not a huge fan of ETFs because of the underlying asset. That said, if there is an ETF that I wouldn't mind buying, it's something like a gold miner or the juniors. I did buy some JDXJ the other day just because it happened to be cheap and I didn't have time. I haven't had time to research like I should. But pretty darn, I think, in my opinion, you're buying all the stuff I like. That's for sure. As far as the percentages and how you're building your portfolio, I'd have to look into. I'm not seeing your whole thing because you're just telling me specific dollar amounts for specific purchases. But so I can't really help you there. But as far as what you've got your eye on, I like all of it. Emmanuel, thank you for the super chat. It says, didn't hear your answer. Do you remember your answer to this question? In the past video, you said that if the stock market goes down, the corporate bond market goes down too as a result. Why? How are they correlated? Okay, because the corporations now have so much stock of their own stock on their balance sheet that if the stock goes down by 50%, that's going to affect the asset side of their balance sheet. And it's going to make the assets side of the balance sheet go down, while the debt side of their balance sheet, what they had to borrow in order to buy those shares in the first place, that does not go down. That stays the same. So if the asset side of the balance sheet is going down and the debt side of the balance sheet is staying the same or going up because of the cerveza sickness, that means that Moody, if they're paying attention, not Moody the millennial, but Moody the ratings agency or the S&P should, not saying they will, but they should downgrade the entity. And if they downgrade the entity, then that most likely makes the share price go down. And even if it doesn't directly make it go down, it reduces the entity's ability to borrow more. Therefore, they won't be able to buy as many shares back. And if they were, call it 90% of the market going up in the first place, and if you take that buyer out of the market, that's most likely going to put more downward pressure on their stock, and then it becomes a doom vortex. That's how it works. Now, there's a lot more components in there, a lot more variable. There's quite a few more variables, but just kind of the broad strokes. That's how I get to that kind of self-reinforcing process that the guys at Real Vision and Raoul Pal have done such an awesome job of explaining. Probably a better job than I have. Andrew, thank you for the super chat. Is there anyone you trust in Medellin to help a U.S. buyer get a good unit Airbnb post pandemic? Peso's cheap, it sure is. How much can you buy for 100K? When will you start sharing your cheap list via email? So great questions here, Andrew. I think you're seeing things very similar to the way I'm seeing things, and that the market here for Airbnb in Medellin, and I don't know this because I haven't talked to any of my buddies in the business since we've had the cerveza sickness, but I would assume they are getting crushed. And as a result, we're going to have some very motivated sellers in the next year, in which case you could get some smoking deals, not just because the peso is cheap, but because you've got these motivated sellers. So I think it would be a good time to start looking for sure. As far as 100K, it can buy you, it will most likely buy you a lot more in the next year than it would have bought you in 2019 for the reasons I was just talking about. And to be more specific, in the next year with 100 grand, I think you could buy some really, really awesome properties with that amount of money and get a really good RV ratio. As far as your first question, the only person I would trust in Medellin is me. That's my best answer. Sebastian has got a list of properties that we've looked at in the past, and I think that when we get through the cerveza sickness, Sebastian is going to be able to find a lot more properties that get onto our quote unquote cheap list. But there's a couple operators that I like, but and I know personally. But as far as just knowing that segment of the market and just these areas where I invest, and it's not like I invest in Medellin. There's just a couple little neighborhoods. That's it. I don't think anyone knows those neighborhoods as well as I do. All right, Conrad, thank you for the super chat. When I finally get my credit score to 620, oh no, you got to watch. Meet Kevin. He can help you with that. Kevin, that's one. He might not get the macro perfect, but he's definitely good with the personal finance stuff. Oh, and the one guy who's a great buddy of mine who I'd suggest going to for the credit score stuff would be Marco at Whiteboard Finance. I've interviewed Marco. He's a really good kid. And if you want help with that, I'd start with Marco and then look at Kevin's stuff and Graham's stuff. Probably has some good credit score advice. I'm not, as you know, I'm not that guy. I don't have that area of expertise. As far as in Canada that could help you, no. Or Canada or California. I'm not sure if you're talking about California or Canada. California, I'm not a big fan of California real estate right now, and I'm probably a less fan of Canadian real estate. So, no, I don't really like those markets, and I don't know anyone, unfortunately. If you're looking for a good RV ratio, you're most likely going to have a hard time finding it in either California or Canada. Emmanuel, thank you for the super chat. In the past video, you said that if the stock, or no, we already did that. Okay, Ryan, thank you for the super chat. Do you think we will hit deflation the next few years before inflation in real estate? In other words, or in your other videos, you mentioned holding off buying. Well, you've got to figure out what type of real estate you're referring to. So in my own mind, I'm breaking things down by shelter and everything else. So shelter is just a basic apartment, a basic triplex, a basic apartment complex, or just your straightforward single family home in a great linear market in an awesome neighborhood that's just pretty much a roof over your head, nothing fancy. I'm seeing that as where I want to be if I want to get into the market. And I would be looking, but I wouldn't be gung-ho right now. I'd be patient, because I think that you could potentially get some better deals in the next year or the next 2 years. That said, like you've heard in my videos, it takes a long time for the real estate market to turn. It can happen dramatically, but to go down by 40 or 50%, that often takes years and years and years. If you look at Japan, it took 15 years for it to go from peak to trough. And when they had their blow up in 1990, when we hit our peak in 2006, prices didn't bottom out until 2012. So it can take a long time. Now, there are some different variables now in today's market that could produce fire sales and to have the market go down faster. But then there are also variables that could prop it up, in the sense that the Fed comes in or the government doesn't make anyone pay their mortgage for a year with these programs, as they got a Fannie and Freddie mortgage. So there's a lot of cross currents, to say the least. It goes back to, I'd look right now, if you can find a smoking deal, looking back throughout compared to prices, inflation adjusted throughout history, do it, because debt's definitely cheap. That's for sure. As long as you're taking 30-year fixed rate debt. But if you can't find something that's just perfect, I'd hold off. I think patience is going to be a virtue. And then Connor, thank you for the super chat. Didn't have a question. And Sanjay, thank you for the super chat. Didn't have a question there either. Okay, guys, that a marathon session. Well, 2 hours and 40 minutes. Holy cow. That is the longest live stream I've ever done. And we still have 870 people on the live stream. Wow. Thank you very much for staying on that long, guys. That's really, really cool. So let me, before I go, let me read off some people's names here. I always like giving them a shout out for being on the chat stream all the way to the end here. So Atlas, thank you, Atlas. I appreciate it. Arthur Martinez, thanks for staying till the end. Hank, thanks for staying to the end. Flying Dutchman, Carlos, Benjamin, Ronald, 2 Timothy, a Bible verse, stayed all the way till the end. Thank you. Ralph, Red, Willie, Gregory, Alexander, William, Jordan, Scott, Ricardo, Jurgen, Gus, Liggy, stay curious. Hey, there he is. I always see you in the comments. Arthur, Ben, Sanjay, Chadisms. I always see you in the comments as well. Jay, and Chad, I think I see you on Twitter too. Jay, thank you. Merton, Jeff, Stephen, Rain, Jacob. Okay, guys, I got to get some lunch. So thank you for your time. Thanks, Sebastian. Jeez, he's probably still on here. And I will see you on the next video.